Hey guys, I thought I'd do a video on the election cycle because all I've heard this whole year is that it cannot be bad because it's an election year. And that couldn't be further from the truth. Historically, yes, election years from October on are very bullish. Okay. But it depends on the macro environment and the circumstances and what has happened prior to that move. And I'm going to show you exactly what I'm talking about because those people could not be more wrong. And this is not my opinion. I'm going to go back using data, 100 years worth of data, and let's unpack it together so that you can actually see what I'm seeing just to disprove what they're saying. Okay, so this is what they're talking about, the fact that the election cycle from here is that you have the election. We're here right now in October, where you normally get a little bit of a pullback like we have, and then we go absolutely ballistic from October. Okay, so this is what everyone's waiting for. And this is the crypto halving cycle that everyone talks about as well, in that we have that run up, get a pullback, and then from there we go ballistic, and then you get your bear market in crypto, and then you get ballistic again. Okay, so let me go through and why this year could be different. Well, different to what they're expecting, but not different to what actually history suggests, which is what I'm going to show you. So what I've got here are the election years, and we're in one this year. Okay, and what we're looking for is that from October, we go really, really bullish. Okay, so coming up soon, what everyone's expecting is from October, we should absolutely rock it. Okay, prior to that, we had 2020. Okay, and if you look at that, you can see that we had a drop prior in the early part, but from that October, which is around here, okay, you see we had a little sideways, and then yes, they were correct. We had our massive bull market. Okay. What I want to show you though is prior to that election cycle, we actually had a 2-year correction. Okay, so what you've got here is a triangle correction. That whole thing there is an A, B, C, D, E. Okay, A, B, C, D, E. So that is a corrective move, that whole move. So what we actually had was a 2-year from 2018 to 2020, a 2-year correction before we had this major big move on it. Okay. So just wanted you to take that in. 2-year correction, so a bear market before the pump. Next one prior to that, 2016. Let's look at what happened. Okay, so 2016, October is right here. So right again, in October, we had a raging bull market after it. Look at that, up to there. Prior to that though, what did we have? We had a sideways market from 2014. So we had another 2-year correction prior to the pump. As we know, markets zig, zag, zig, zag, zig, zag, zig. Okay, so again, it was bullish because we broke out of a 2-year base before. And that's where you can see it. All right, let's go back to the next one, 2012, October. 2012, October. So where's that? Here. Okay. So again, what did we have? We had sideways, really, to be honest, from here. That whole move is sideways, a little bit of upside there. But again, that is an A, B, C before moving up. So a corrective move from 2010 to 2012. Again, pretty much a 2-year sideways before the pump. So pump, sideways, pump, sideways, pump, sideways, pump. Get what I'm saying? Okay, prior to that was 2008. Okay, so 2008 October, now we're here. So actually that one was bearish. We actually dropped until March the next year because we didn't have that 2 years sideways. We were already in a bear market. Okay, we didn't have that consolidation before the pump. Okay, that one's different to the other ones. Let's go back again, 2004. October, which is here, right there. What did we have? We had a prior bear market, nice little pump, and then a nice sideways market from January to October. So pretty much a 10-month base before we broke out and started to do well. See what I'm getting at? Sideways action, pump, sideways action, pump, sideways action, pump. Okay, another one that we want to look at now is before that was 2000, October 2000. Where are we now? We are here. That one was one of the worst crashes we've ever had during an election cycle that's supposed to be bullish. Why? Well, let's look at the data. Did we have a sideways movement before it pumped? No. Did we have a parabolic bull run? Yes. Did we have the yield curve inverted? Yes. Did we have the yield curve inverted? Yes. Did we have the yield curve inverted on any of these? No. See the difference? Where are we right now? Yield curve inverted, just uninverting. Have we had sideways markets prior to, or have we had a parabolic run? Have we had a year or 2 year base before this October, or have we had a parabolic run? Do we have a yield curve inverted, or do we not have a yield curve inverted? Different story. All right, that's only 4 or 5. Let's go back and check it more data. Let's keep going. So this is why it's important to unpack data and see where we're at. So prior to that was 1996. Again, let's look at that one. October 1996, where are we? That's here. Okay, so that one there, you can see had a pretty good run there. And, we at least had some nice sideways, but okay, that one we could build a little bit of a case. But again, it's still kind of at the early run after a massive crash. Maybe that one is, let's go back again, 96, 92. That one's here, October. What did we have prior? Massive sideways ranges before. So November 91, so a 1 year base, and then also another year base before that, before it kept going. Okay, so again, sideways before the pump. Even this one in 96, what did it have? It actually had a sideways from January 96. So it was trending sideways before it broke out. It wasn't up in there. We had a sideways range for a year. It doesn't look like much now, but that is a year. February 96, well, when did it come up there? January 96 to September, October. So we were trading sideways before we broke out. Okay, sideways before the break. So we weren't in a parabolic run. The only time we were in a parabolic run was there. We fell off a cliff. Okay, let's just go back to some of that. I want to then show you other times when, okay, it hasn't been great. Let's go back to the 72.68. All right, so back here. 72.68. So 68 October, right there. Did we have a year sideways before? What happened? Massive crash, took out the lows from before it. That's an election cycle. But hang on, we just had a massive bear market. Why? We didn't have the sideways range before it. Okay, let's look at 72 election cycle. Right here. Did we have a massive base? Well, we had a little bit of a one, at least from March. But what did it do? Pump and then massive bear market. Hang on, that's an election cycle. Aren't we supposed to be bullish? Okay, so see how it doesn't work. And then the 68 before that, 64 October. Here. We pumped and then crashed. Took out and then crashed even more. So again, and then this time, again, yield curve inversion, recession. See, where are we in a recession or are we in a nice strong environment? Recession wasn't good. Recession wasn't good. Recession wasn't good. Non-recession, sideways market pump. Massive difference when you actually unpack the data properly and realize that, okay, one, are we likely going into a recession? Yield curve tells you yes. Many other indicators tell you yes. Have we had sideways consolidation before the pump? No, we've had a raging bull market, one of the biggest we've had. On top of that, where we are right now is at 1.618. Okay, top. It's also the massive, if you go all the way out to the 3 monthly, and go in your log, you'll also notice that we are at a massive channel resistance right now. This is the top of the Great Depression. The Shiller P ratio has only been above 34 times. That's 1 time, that's 2 time, that's 3 time, that's number 4. So equities are historically overvalued as well. On top of that, we're hitting this resistance on bearish divergence. If you notice, last time in that time when we had bad things here, what did we have? We had bearish divergence from the Great Depression to there, and then each one of these, same as this, bearish divergence, same as this. So I don't believe we're going to get a massive crash. Well, we might get some like that, but I believe we're going into a decade-long sideways market where we just float around and do nothing for the next decade. All the data suggests it. I'm going to do a massive video soon that will probably go for about 2 hours explaining why I have bear as my profile pick. I've never actually explained it to anybody. You're getting a little tiny snippet, about 5% of why right now. But these are the things that you've got to look at. Where are we? It's showing weakness going into it. Looking at the weekly right now, what do you see? Okay, right now, let's look at the bottom here. The bottom here. You've got bullish divergence from that low to that low. Then you've got complex bullish, which is where you've got it again from there to there. You've now got the opposite this way. So you've got on the wider scale here, bearish divergence from there to there. Then you've got bearish divergence from here to here. Classic topping pattern. Okay, bearish divergence, same as the bottom here. You're now getting up the top here at the 1.618. Let me show you why that 1.618 is so important. So if we look at back at those 78 times I was telling you about. Okay, that was the 68 one I was telling you about. So if we go fib retracement from that move to that move, what did we hit up to during that recession, during that election year? The 1.618 right before the crash as well. Okay, so this is where I believe we are right now. We've had, you had your raging bull market leading up to it, like we have. You had your blow off, then it corrected it like we did in 2022. We've had our raging bull market. Everyone thinks and they don't realize that it's actually been corrective. And then we come out and take out those lows. That is what I believe. I don't know if we're going in a triangle. I think it might be a big expanded flat, but all data suggests that you have to be really careful here. I'm not going there yet. I'm just showing you possibilities, and that there's a lot of warning signs showing you those same kind of thing. Even if I was to pull up the Dow Jones Industrial and Transportation Average right now, I'll show you that as well. So you know how I just showed you that we are very similar to the 08, the tech bubble, and the 68, 72 range when we went into recessions. Now I'm going to show you why the Dow Jones Transportation and telling you the same signal as well. So what you've got right now is the 2022 top, which is there. What you can see is the industrial average has made a new high, but this hasn't. Okay, that's called bearish divergence, where you've gone a new high on the industrial, but you haven't on the transportation. On top of that, so that's from there to there, but even from this high here, you can see we're matching here, high, low, high, low, but everything from here up has been on bearish divergence too, because that's gone higher and this hasn't. Okay, so not only from there to there is, but also this last move is as well. So we've got this is Dow theory indices should confirm. Okay, otherwise it's a weak trend. Let me show you every time similar where we had it. So this is the COVID drop here. Okay, so this is COVID. So there is here. And you can see that one matched, we're okay. All right, that's all matchy. And then you'll notice here, look, we made a new high, but we didn't make a new high, bearish divergence. So again, that took time to play out. That was December 18 to February 20, December 18 to December 20, it took nearly a year and a half to play out. And this is why these macro people, they're not very good at timing because they don't know how to read charts. I realize that sometimes things can go on, they can disconnect for a long period of time. But that was a corrective move. Like I said, that was all one big triangle. And that ended up being the big correction that we had, similar to what we've got now. Okay, let's look at the other time, GFC. All right, GFC here as well. And where are we here? GFC here. Okay, so same thing, the GFC topped here. Okay, topped here. And if you look there, that top there, October 07, this was here. It had already started correcting prior. And then when this one then came off and made a new high, hang on, this one made a new low. What's going on? They're not saying the same thing. Okay, so same thing. It wasn't as big as the one you just saw at COVID and right now. Like it's only that period there, but still had it. Now let's look at tech bubble. All right, tech bubble topped out here. That's here. So the tech bubble had already put in a top and it actually topped here, made a new high, double topped. Then from there, we'd already started to fall away. Okay, so divergence again on the top from there to there. Okay, another sign that you had divergence not matching. Now I'm going to show you the 87 flash crash as well. So back here on the 87 flash crash, let's go right in on this guy. And we're going to have to go down to the daily here. Let me zoom in. Okay, so I've come into on the 87 flash crash into the daily, just so you can see. So from here, you can see we made a new high, but here we made a new low. Okay, bearish divergence. So then once it moves into convergence, which is where lower low, lower high, lower low changes market structure, changes its breaks below, then that's where you can see again you had that bearish divergence on the 2 before it rolled over as well. Again, only on the smaller time frame, but you still again had it before a major crash as well. All right, so you will get these divergences in your indices before they get it, and we're getting it right now as well. Just another thing showing you that, well, have we had consolidation before the pop like every other bull market when it's been good? No. Have we had a raging bull market like the times when it fell off a cliff? Yes. Are we looking like we're in a recession like the other times? Yes. So the chances are actually the opposite, that actually if you unpack the data properly, it's actually pointing towards being mega bearish. And if you also look at the indices right now, they're showing you the same signals it had at the bottom, but now at the top again. So actually, if anything, if you actually unpack the data properly, things are looking super bearish right now. You unpack the market sentiment right now, and the high is 52. You know, if you're above 50 is extreme greed. We had 2 weeks of extreme greed. Even now with 2.2 trillion wiped in a week, it's 45. We're still up in very greedy. You know, so retailers are just, and you heard it all over after that flash crash and it got bought back up, that it was just going to be, you know, everyone was just, we're never going to go down. People just think it's programmed in that it will never go down. And it will eventually. When? We're not sure. And what we're looking for is where it moves from convergence to divergence. So on looking at this one here, what we're looking for is when we go back to where we are now, we go right back and let's go to the weekly. We'll go on the weekly. Okay, looking at it again, what have you got? Bearish divergence on expanding right now. Bearish divergence coming up. So once we break, or if I should say, we break below here, then you've gone bearish market structure. Okay, lower low, lower high, low, double top coming down, and then once this breaks below here, so once that breaks that level and that breaks that level, that is confirmed, and I believe the market will drop very, very quickly. So just be really careful. Again, this is predictive TA. This is what I think could happen, so I'm prepared. Preparation is the key to success. So I'm, you know, everyone's ready just to buy the dip straight away. No, I'm waiting for confirmation before anything else, because looking at the actual data, things are not looking crash hot right now. Sentiment is extremely bullish. People just think that the market will always go up. This is what happens. People also don't get why the market's going up. That's what you get in these kind of at the ends, in the pointy end of stuff, because that's where technicals disconnect from fundamentals. That's what we have right now. This is the Shiller P ratio. As you can see, we're 30. The only times we've been in a Great Depression, tech bubble, 2022 now. The only times we've been above or even 25 to be honest. Okay, and I showed you on that SP 500 chart where we are at the resistance band right now, showing weakness as well. So what you need to ask yourself is, are you the best trader on the planet? Because if you're not, and you don't have a track record of calling major tops and calling major bottoms and knowing how to exactly get in and get out, then you're playing with fire right now, because there's a lot of data saying that we are very overextended. And do you need to get every little ounce of blood out of the stone? Or do you know when something's extremely overvalued and not looking good, do you then go and find something else that's undervalued? And when something's overvalued, there's always something else undervalued. That's what money does, it rotates. Okay, so play it smart, get away from the risk on assets. Again, I'm just going to show you another chart showing that. Okay, this is the NASDAQ to SP 500 ratio. This is the tech bubble. When the Schiller period is so expensive, we're up here again now. If you look at this recent high, when something breaks resistance, it's for one of two reasons: to continue the trend or grab liquidity. Right now, you've broken resistance and come back within. On top of that, on massive bearish divergence. Okay, now let's zoom in. That's the monthly. Let's go into the weekly. Now, on top of that, what you've got is, again, an end in diagonal, expanded end in diagonal here. And I look at this and go, okay, this was your bear market. You can see here, November 2021, when crypto topped out, coming down here, bottomed in December. This is your bull market. I look at this now and go, hang on, why are we buying lower? Why are we selling lower? The minute we go below there, we have a change of market structure. Okay. Then I look at that and go, well, remember all those other election years when things were really good? They were when we were in a risk-on environment, when money was cheap, when we were in a Asian bull market. But when it was 2000, October 2000, what were we in? We weren't in a risk-on, opposite. Okay, so that's what we've got to look at, in the fact that, are we in this Asian bull market where, yeah, election cycle will be good, or are we actually in a different environment where it might not be as good? I think risk-on assets are about to get absolutely slaughtered, or like I said, best case, what are you going to get? Another 6 to 12 months tops? Why play with fire when you don't? There's a lot of reasons why it could be topping right now. And as you can see, after a big move like that, you can get a massive correction. So you'll be looking at a massive 1/3, 2/3 correction. See that 382 aligns with here, the 5500 back to the tech bubble part there, or what I believe it could come to is a 618, which is this resistance support here. Reason why I've got that one is it also aligns with just your vertical basic trend line. Okay, this stuff should be going up at a 45-degree angle. This is not normal. So it's actually normal for it to come back to what's called mean reversion before going again. So that's not even, that's still a decent, it's where it should be at a 45-degree angle. You think it's a flash crash. It's only because you bought the top. That's the only reason why it's a flash crash. If you were smart and bought when everyone else bought back in 2012, here, when it broke out, beginning of the public, then different story. But you're buying the excess phase right now. Okay. What that means is that excess phase, you correct the whole move. Excess phase, you correct the whole move. Okay. So just be careful. It's an old saying that the stock market is a voting machine in the short term, but it's a weighing machine in the long term, which means that it runs off popularity and goes crazy in the short term, but eventually you get mean reversion and everything comes back to where it should be. 17 is the average. That's 50% of where it is now. So the whole market could crash 50% and just be normal, let alone if we go into a bear market, which will be single digits. So it could crash 70, 80% if it was to get nasty. But you see 50% as a crash, all it would actually be doing is coming back to normal, because it should never have been here in the first place. All right, guys, hope that helps. I hope it's blown this myth of election cycles out the door, because now that you can see data, you can actually understand why things. And crypto, the halving cycle is the election cycle. So the only thing that crypto has ever existed in, crypto was born here. It's only ever lived in a money is cheap growth environment. It's never existed in the opposite. It's never existed in this, never been in a recessionary environment. So you're in uncharted territory. So all these people going, 4-year cycle, going to this, going to 150K, going to 500K, going to million. You can't go off any past data because we've never been here before. So follow the charts, don't go off any past cycles because it hasn't been around in enough to even know how it exists right now. Okay, follow the charts. Right now, all time frames are bearish on it as well. So until they start changing over and telling you elsewise, be very, very careful. All right, guys, take care. If you like the video, please like and subscribe, and I'll catch you on the next one.